You look at intra-quarter price action as a guide to where expectations are highest, and you zero in on Snap, Baba, and Uber for where we think that we're going to get some good results, right?
I think that's right. But, look, we lead with fundamentals, not necessarily trying to follow the stock prices. You made a point earlier I think is really important. This is a big year for global advertising. Global advertising growth should accelerate. You've got U.S. presidential elections. You got the Summer Olympics. You got the EU Cup, Soccer Cup football, they call it over there. All those are big advertising events. And there's two companies that I look at, Facebook and Google, that are clear derivative plays off that. So we like both names. We like the valuations here. But fundamentally, we think they're really well set up for the year and for the quarter.
All right. Areas where people are still a little skeptical. You're looking at Trip for obvious reasons and Pins. How would you touch them with a 5-foot pole, a 10-foot pole?
There's a So let's look. Pinterest is for us a nice, good speculative long. There's 2 or 3 names that we're very cautious on in large cap internet. TripAdvisor would be one, and eBay would be another, and probably Twitter, too. That's kind of with a year-out perspective, although I think Twitter is a unique asset. They need to bring down margins. They need to reinvest more aggressively in their business. Where I think the greatest skepticism is across this consumer internet space is actually our favorite long for the year. That's Uber. I know the stock's recently rallied, but still, this stock is deep in the doghouse for a variety of reasons. Lots of losses, a broken IPO. But if they can really prove that they can dramatically reduce losses as we go through the course of the year, I think this stock can re-rate materially. I'm not talking about 20 or 30% upside. I think the stock could almost double in a 12 to 18-month period.
Well, we should mention the Dow touching an all-time high while we're having this conversation. I got to ask you about Snap, because you call it out both for among the highest Q4 expectations and also the least risk. How can it be? How can the bar be so high and yet it be so clear to you that it's going to clear it?
I'm trying to do 2 things. I look at stocks fundamentally, and I look at stocks versus their expectations. And, I think the way you make money in these, if you're a patient long-term investor and you can stick around with a Netflix for a decade and an Amazon for a decade, you can get 10 baggers out of focusing on fundamentals and kind of avoiding the expectations. But near term, the expectations are key as a setup. What I find interesting about Snap is I think fundamentals have improved for 3 or 4 quarters here. I think they finally fixed their app so it works well on all Android devices, which is really in an Android world, not an Apple world. And then they've rolled out a bunch of interesting new feature innovations, and some of these seem maybe cute or quirky, but like these gender filters and age filters, and now they're rolling out these cameo filters, within the device. I think they're really creating a really sticky app, and we're seeing rising levels of satisfaction. It's a name you want to continue to own, Snapchat. It's a little more speculative. It's not as clear. It's not as strong, nearly as strong as Facebook or Google. But if you're willing to go out on the risk spectrum a little bit, I think Snapchat's an interesting long.
What do you think is going to happen with Amazon when they report their numbers? And what are the key things to watch? And is this an earnings report that could actually kick this name into performing or outperforming again?
Yeah, the risk that we see here is the street seems to be a little bit ahead of its skis. Over its skis in terms of the operating income that the company is expected to guide to for the March quarter. December quarter numbers seem fine. But for the Q1 outlook, I wouldn't be surprised to see them guide below the street on operating income. We're trying to flag that issue for investors that could cause a momentary, fluttering down of the share price. I think the core thesis is well intact. The one major overhang right now on Amazon has to do with AWS, which has been the real big growth part of the stock over the last 5 years. The concern now is the growth in cloud is in the enterprise and it's in hybrid cloud solutions. And there's a great competitor in that space, and its name is Microsoft. So Amazon's got to prove that AWS can still maintain 30% plus robust growth rates with good, solid margins, despite the competitive field becoming more intense in the enterprise. That's what they need to prove.